So our last session, as I said, what we're going to try and do is bring together some of the lessons and insights from the sessions that we've had yesterday and today. But before we do that, as I mentioned, we're fortunate to have two sponsors who helped us with this conference. One was the University of Southern Queensland and the other was King Wood Mallesons lawyers. We have with us Stephen Jaggers, who's the partner in charge of the Canberra office of King Wood Mallesons. Stephen specialises in investment funds and acts for three of Australia's major banks. He also acts for the Commonwealth Department of Agriculture. In addition to agribusiness, the King Wood Mallesons team specialises in foreign investment and have handled over 25% of all the applications made to the Foreign Investment Review Board in the last 12 months. So to say a few words about Kingswood Malleson, please welcome Stephen Jaggers to the microphone.
Thank you very much. I won't say too much because I think we are more interested in the panel sessions to follow. But for those of you who don't know us, you might know the firm Mallesons Stephen Jaggers, or that name a little bit better than King & Wood Mallesons. Just over 2 years ago, we merged with a very large firm in China called King & Wood, and 6 months ago merged with a firm called S.J. Berwin in Europe. And what that's led to is us now being the largest and the first global law firm that's headquartered in Asia. Our strategy is quite different. We're global, but our headquarters is and always will be in the Asian region. So we're the only firm that's able to practice English, Australian, Chinese, European and Hong Kong law. And in particular, the Chinese connection and the Asia connection gives us really unparalleled relationships and depth of penetration into that Chinese market, which is leading us to become the go-to firm for both inbound and outbound Chinese deals in a whole range of sectors, but including particularly agribusiness. Agribusiness is something our firm has been at the forefront of for many years, and the food and agribusiness team in our firm is amongst the market leaders in the Australian market. You would have received in your pack this publication, which we put out a little while ago, From Farm to Table, looking at a guide to investing in Australian agribusiness. We also publish quarterly a web publication called Agri-Thinking, which is just a regular update on legal issues affecting agribusiness. So I'd invite you to go to our website and look at that publication when you have the time. But we are delighted to be one of the sponsors. I think the conference has been absolutely excellent, a great topic. All of the speakers have been thoroughly insightful in their comments, and I'm looking forward to participating in this final session. So thank you.
Thanks, Stephen. Okay, so we're not going to extend this out too long, but I thought it would be a useful exercise to bring some of the thinking together and try and distill out a few key messages out of all this. So I asked the learned gentleman on my right to volunteer for a panel session, and hopefully most of you know them, but Graham Jennings is the former manager of agribusiness for Westpac, David Sackett, the CEO of Growth Farms and also a member of our Research Advisory Committee, and Ben Russell, the CEO of Rabobank in New Zealand, and also an expat Aussie, or I'm not sure what he is, he's a visiting New Zealander or something. Anyway, so I asked them three basic questions, and I guess the first one, I'll lead off with that and I'll be interested to see their response. The first one I asked them was, do you think Australian agriculture will be able to attract sufficient capital to expand in the future? So there's some assumptions in there. Obviously the issue of the value of expansion is and the opportunity for expansion is obviously a quite important part of that question. But I'm just interested in their thoughts about this issue of whether capital and funding is the limiting issue, perhaps in terms of the future expansion of the agriculture sector. So I don't know who wants to start. Ben's got the microphone and he's a pretty good talker, so maybe he'll fire up and we'll see who else wants to add comments as we go through.
Thanks, Mick. when you sat down next to me last night with a glass of a bottle of wine, I thought you just wanted to have a catch-up, but you actually fingered me for the panel here. So it's a really good question, and I think you think about what capital is going to be needed over the next, say, generation in Australian agriculture. And the first thing to realise is that one of the speakers yesterday said there's a big need to actually fund succession. So family farmers, which are still by far the majority of farmers in Australia, they have a huge amount of accumulated equity that over the next 10 or 20 years is going to be withdrawn out of those family farms. Some of them will be generous enough to leave their kids some equity in the business to gift it to them. A lot of them won't, and quite reasonably. So that equity is going to come out of the agricultural system by and large, and it needs to be replaced. There are challenges around replacing that solely within the resources of farming families, and some of the examples I guess I gave yesterday in terms of the range of different structures that New Zealand farmers have used around equity partnerships and share milking and the like, I think are quite good ways of trying to bring in that sort of private equity in terms of private individuals, not PE firms. But I think that expecting families to provide the replacement capital is a big ask. So I think they'll be able to provide some of it, but not all of it. So then the question is the external sources of capital from professional investors, people who invest money hoping for a return. And we heard a bit about the potential investment tsunami, which is coming. I'm a little bit sceptical that it's going to be a tsunami. I think there's a lot of money out there. Investors aren't stupid. They're not just going to throw money at agriculture. Financial investors in particular, where they're looking for some level of financial return. And Ross's figures I thought was very, very interesting, because essentially the top 25% of farmers are making that sort of accumulated wealth of 6 to 8%. That probably fits broadly with the needs of a long-term investor, not a short-term investor, but a longer-term pension fund type investor. So I think those sort of farmers will be able to find that sort of capital. It fits their investment appetite. Question is, what about the next 75%? And I think those people, by and large, those farms are not very profitable. And there's some real issues around them for the longer term, and they either need to find the Chinaman who wants to buy a farm with kangaroos on it, and that would be a good fit perhaps, or those farms need to move into the hands of people who can lift those returns into that range, where a financial investor is going to be happy to put their equity, and I think that's a challenge for agriculture.
Thanks, Ben. I think the answer is fundamentally yes, in that I think, despite some of my negative comments, and I think I scared a few people yesterday, I didn't mean to scare you. It was, or paint a very negative picture. I think it's actually a very positive picture. We've just tainted it a little bit. So yes, I think we'll attract the capital, and I think we'll think about it in two ways. There'll be a lot of the capital, and the majority of it will come from within agriculture. Successful family farm businesses, the sort of data we've seen by a number of people from Plan Farm, from Ross, about those top farms are generating substantial surpluses, substantial profits, and the logical place for them to reinvest is back into agriculture, because they've got a competitive advantage. So I think yes, there will be a lot of money recycled within agriculture. I think the key thing we need to do is not encourage the bottom end to stay there. So we need policy settings that encourage people to leave rather than stay when they shouldn't stay, because that slows the pace of adjustment and it makes it harder for the top 25% or whatever they are to expand. So I think that's really important. We've got to get the policy setting right and stop this knee-jerk rubbish of going out and drought things and all that sort of stuff that goes on at times. And we as farmers have to stop asking for it and demanding it when things go wrong. I think there will be a small proportion of the money will come from outside the sector. And I think it will almost certainly, I don't think it's going to be a tsunami. I think there's going to potentially a lot of it. But in terms of the value of the agriculture sector, it won't swamp it. I think it, as we talked about yesterday, there are some good stories and there are some bad stories there. And I think from my experience, investors are getting more and more discriminating about going into it and have been realistic about what's achievable, but also focusing more and more on things like alignment that we talked about yesterday, and ensuring that people who they're trusting with their money give them the best chance of achieving returns. I think the other component that will drive it, so really what we're talking about is internal capital, and that's, if you like, pulled and staying within the system because it provides attractive returns. I think the outside money is going to be as much of a push as anything, because the amount of money that sits in endowment funds and pension funds and all those sorts of things needs to find a home. And obviously only a very small proportion of it's going to come into agriculture. But the reality is that if you look at where they're going to park it globally, Australia has substantial competitive advantages in terms of the sovereign risk, in terms of being a low-cost producer, in terms of being a substantial exporter. All those things make Australia really attractive. And to some extent we're there by default because a lot are unattractive, and we've got to make sure that we continue to be attractive and be competitive. So I see that as the push of money coming in, because it's got to be parked there somewhere and it's better than the alternatives.
Graham, has the banking sector got an appetite for more exposure to agriculture?
So a lot of consistency here in terms of yes, but I guess my question will be how optimal will it be? It seems to me a fairly unplanned approach at present, and a heavy reliance on bank debt funding, bank debt lending. And banks will definitely play an extremely large role, as they have. The question is, you know, where's that heading? You know, what are the underlying trends there, and what fills the void, and how adaptable, how can they change, and how will that work? So a few things that are happening there. For instance, obviously, you know, from a bank's point of view, more and more it depends on the return on capital the bank gets from lending to the sector, because it's got plenty of sectors. You saw, you know, how the Australian economy is constructed, including the mortgage sector, and, you know, banks are looking at the returns they're getting on each sector, and agriculture's competing amongst every sector of the Australian economy for bank funding and relatively scarce savings. So fortunately, Australia is saving a bit more. Fortunately, in the sector, we've seen a bit of debt reduction, but relatively scarce savings, relatively scarce capital, and banks don't want to be using any more capital than what they need to use. At the same time, then having a sales force out there, or relationship managers that are driving up and down driveways of farms, sitting around kitchen tables and, you know, working through with some farmer over a period of time, you know, exactly what they're trying to do, what they need, managing all of that, taking it all back, processing it, etc., running it through the system, that's not getting cheaper. And in fact, what we're already seeing is, you know, banks are pretty much focused on the top 20% of farmers, so great, they're the ones that seem to be growing and doing things, but there's a whole big rump out there where I'm not exactly sure that they've got the confidence that they're going to get what they need into the future. And in fact, today I'm not sure that some of those people have quite got the confidence that they can get the access they need. So we need a lot more innovation in that space potentially at the smaller end of farming, and we need to deal with some pretty key issues, which I might cover in the next question. So I guess the answer to me is there needs to be a fair bit of this sort of discussion. There needs to be a fair bit of preparation, planning, policy, but it needs to be much more collaborative. It's been quite a fragmented approach, and it's very easy to start flinging mud at each other and, you know, just blame the banks at the end of the day. That's actually not going to be the answer to this.
Thanks. Stephen, you're seeing, I guess, from the international perspective and the inbound capital, where do you think that, I mean, obviously that's probably targeting the top 25% at all, as well, if it's targeting agriculture.
Yeah, we are seeing quite a bit of demand, particularly from China, and we've also heard about the demand from the US, which Michael Whitehead mentioned in his talk yesterday. I agree it's probably not going to be a tsunami, but I think it is significant. There is some issues that need to be addressed, and we can talk about that when we get to the further questions. But I do see, in terms of there being sufficient capital, certainly that corporate end of the spectrum with large SOEs and institutional investors from offshore coming in, they will obviously resource that to a sufficient level and have the capital to optimise the results from the investment. At the other end of the spectrum, the sort of family-based model, I actually don't think the problem is sources of capital or variety of funding structures. I think it's more fundamental in the question where it's about sufficient capital. And I think for a lot of that top 25% we've been talking about, they're doing quite nicely, and they will invest returns back into the business and invest their own capital internally back into the business. But there is a question about, is that sufficient? Yes, sure, it might be sufficient for them to continue to make a good living and achieve a good business growth, but could they do more if they had access to more capital? And for those outside the top 25%, sufficient capital for them might be just survival or marginal improvement. I think what really needs to drive sufficient capital in terms of optimising returns and growth from the sector is looking at those alternative models. The sort of things that Ben was talking about in New Zealand, changing ownership models which free up capital and allow access to further sources of capital to really expand the business.
Well, okay, so on balance positive with a few qualifications. So if capital is going to be there, do any of you see any limiting factors that might in fact be the critical issues in terms of future growth? In other words, capital perhaps follows profits, but expansion, what's going to be, we know there's no more land or little extra land being made available. We know there's less water being made available. The resource base is finite in that sense. So what do you, any of you, I'm interested in any of your thoughts about the factor limiting that potential future growth?
I might go first this time. I think we've heard from a number of the speakers quite a few factors. There's been a common theme of lack of transparency in the data, and we heard this morning, we've heard from a number of speakers that for it to be an asset class that's characterised as an asset class in its own right and not as an alternative asset class, you need that transparency in pricing, transparency of market data, and ability to price on a regular basis. So I think that is one thing as an asset class that is limiting. Some of the other reasons which are associated with it is the level of fragmentation in the industry. So the family farm ownership model works very well in a whole range of ways that David spoke about in his talk. But it does mean it's very fragmented. So one thing holding back real growth, I think, is the sort of ownership models and the willingness to embrace the new models, particularly that have been embraced in the New Zealand dairy sector. Some of those things are harder to achieve in an Australian regulatory context, but I think probably what's holding it back most is that people are comfortable with the current ownership structures. There's some complexity around that in terms of family ownership structures, and I just don't think there's enough willingness or drive to explore other ownership models which might open up greater opportunities in terms of capital investment. The sort of things we've heard about share farming, having leasehold, selling to a real estate investment trust and separating that operation of the land from the ownership, but while retaining the proper incentives in place. So I really think that ownership model is a key issue, and more willingness to embrace different structures. I think the financing structures are there to deal with those different ownership structures if there's a more willingness to change the ownership structure.
I might just tackle two issues. So certainly doing the same old's riskier going forward. As farms have got larger, we've seen plenty of examples. The risks have just got amplified with fewer people to manage. So how we manage risk, I think, is a real big issue going forward, and how we take risk out of the system, and from that will flow more appetite for investment, more liquidity, etc. The second issue, I think there's just a cultural, a deep cultural issue. There's some norms that need to be challenged, and we should be, I think the Kiwis lead the way here in the dairy space. We should be celebrating this top performance in agriculture, this top 25%. It seems to me that so much of policy, so much of farm lobby time is consumed around the issues of a larger number of farmers who really do have a struggle. But the future of this country in terms of agriculture is definitely, we've seen it, we know where it's tied to, and it has to be around top performance. So we should be fostering a culture of high performance. We should be encouraging that next rump of producers that are sitting out there to be so aspirational towards getting to the top performance level, which is no doubt where some of them want to be, and there may be others that don't want to be part of that. And if they don't want to be part of that, we need to have that on the table. We need to talk about, well, what is the future? What is the answers there? And maybe there's absolutely a space there. And I appreciate the family farm is absolutely sacrosanct in our thoughts, and people will have fears about returning to a manorial farm system of the 1700s or 1800s in England with the lords of the manor. But that's not going to happen in this world. The world's moved on. It's changed a lot. And in fact, the solutions, I think, are actually a blend of models. So it's not family farm over here and corporate farming over here. There's actually, how do we get the best of these different worlds moving? And to do that, we're going to have to bust some norms in the way people think about things. So they're the 2 points I'd pick out.
We are getting knights and dames back, so maybe there is a chance.
You're in line for one, Mick, didn't you know? I think the single biggest constraint is intellectual capital in our sector. And I think, we've talked about the numbers of people, but graduates coming through. But I think if we focus on building and attracting intellectual capital, the financial capital will follow. And the reason I say that is if we've got good intellectual capital, we've got people who think critically, who are smart, who are receptive to new ideas, who bring new ideas from other sectors, then we will have a thriving, dynamic sector, and we will create structures that work for the environment, whatever that environment might be in the future. And to me, that's the key thing we need to do, intellectual capital. And we've had a drift of that. You know, we've tended to leave the dumb one at home on the farm for the last 20 years. And we send the smart one off to become a share broker or an accountant or whatever. And that's been a real problem for us. And the negativity that we've portrayed in agriculture, which I was responsible for to some extent yesterday, has actually perpetuated that. And so we need to make it an attractive place. And I see farm businesses now with the next generation really wanting to get involved because they see great opportunities in those businesses, and they're in the better end of those farms. So if you like, if we build that intellectual capital, the rest will follow. And the structures, we'll create them. We'll see separation of land ownership and operational structures. We're seeing that now because of the investment mandates that we have at the moment with a range of clients, approximately 30% of that is asking to invest in land only and not take operational risk. There's a queue of farmers who are very happy to lease it and take the operational risk, but these other people have patient long-term capital. They just don't want the operational risk. So it's happening. It's happening in front of us, and I think it will continue to happen. And I think at the corporate end, having some sort of index and transparency is really a fundamental issue that unless we address that we will always have one hand tied behind our back.
Yeah, thanks, David. I completely agree. To me, the main limiting factor is it's all about people. And it's that top 25%. It's how do we breed? Maybe we could put those top 25% together and get them to breed and have more, bring more top 25%ers through. But because once you get that, if you've got a skillful farm manager, they will be able to satisfy the financial needs of the people who want to invest the capital. David's correct. I think agriculture's got a real image problem in terms of trying to, and this is the same in New Zealand, it's the dumb kids, and schools, I think, are largely in their careers planning, that, you know, trying to encourage younger kids who are bright into law and accounting and medicine and, you know, these areas, and the bright kids are rarely encouraged into agriculture. And even in an economy like New Zealand, where agriculture is the dominant sector in the economy, the bright young kids are discouraged from coming into agriculture. And to me, that's I can't think of a sector that's got a better future, and that farm management skill, the ability to run a farming enterprise, to achieve high levels of performance and production and financial results on farm. There's a massive financial opportunity in that for young people. They can make a lot of money if they're good at that, by earning their way into significant farming enterprises. And that skill is very hard to come by. You know, in my banking career, I've developed the view that there's actually no such thing as a bad farm, there's only bad farmers, right? So a good farmer can make just about any piece of land work if the capital structure's right, if the enterprise is not trying to do something that it's not capable of. But that's all about the skill of farm managers. So finding them, encouraging them in, and the people who support them, the scientists and the agronomists and, dare I say it, the bankers, people who understand the cycle. But to me, the key is those really good farm managers who can make a farm work, and we need more of them.
Okay, so just to round that up then, and then we'll throw it open to questions from the audience. But if we're sitting here in 5 years' time, and this is a slight variation on the question I gave you, but that's all right, you can handle it, I know. If we're sitting here in 5 years' time and 10 years' time, what difference do you think we'd see? I suspect you'd say we haven't got 135,000 farmers anymore. But what about farm structures? What about risk management? What about people? If we were sitting here in 5 years' time with this audience, what would the farm sector look like, do you think, from your perspectives? And I know that's a slight variation on your question, but you know, intellectual capital is here, I know that, so I'm sure you can handle it.
Thanks. 5 years is pretty short, but I think agriculture is the last sector in Australia that really still is at cottage industry level. If you look at the number of businesses and the structure of those businesses and the capitalisation of those businesses. So I think in 5 years' time we'll be further down the road of restructuring agriculture into a more corporate type part of the world. Well, like the corner stores have really they are no longer the backbone of retailing, selling groceries. Sure, they're still there and they have a role, but really it's dominated by people who have brought in capital to own the buildings, and they've separated the capital from the operating entities and a whole range of things. So I think that's our path. And I don't think we should try and stop it. I think we'll have fewer farmers. We should celebrate that because that's a good thing. And we need to actually speed that process up as much as possible. So it will be the restructure that will continue on. And I don't think it will be dramatic, but I think, you know, even in 5 years' time, we'll look back and we'll probably think, gee, we've actually come quite a long way in that time. Which way do you want to go?
Yeah, I'll probably put more of a banking spin to it. So at the smaller end, I spoke about the access for sort of smaller finance in the farm sector. I think technology will play quite a role there, and that should happen quite quickly. The challenge is going to be who's sitting behind that. So I think the banking sector will still play a major role in facilitation, but there's obviously, to my way of thinking, more room for suppliers to get more involved through outtake type agreements, maybe input providers as well to get more involved. So they're integral in the chain. So I think part of the answer is working together in the chain with people both sides of the farmer. At the top end, I can see, you know, the products moving on from, we sort of evolved. We had a nice experiment through the 2000s with the all-in-one account, where you just roll all working capital and capital finance all in together. And that's had some unintended consequences. I think the last speaker spoke about the Moody Bank. So you have a crook year and suddenly all of your loan facilities, potentially being recalled in, the whole thing's being revalued, and because the bank's got a downgrade, and that sort of all-in-one experience is not great. It's another function of the way we're doing business today. Whereas the separation of working capital from capital purchases, big capital, and structuring the finance differently, I think will be a manifestation of where we need to go, and will fit quite neatly with where the industry needs to go in terms of getting more liquidity, more flexibility, and different structures. And so I think there is a lot to gain from the New Zealand experience, even from the US experience, even though that's got some different things underpinning it. They're all models we should be looking closer at and moving into in the next 5 years.
Stephen, do you think Mandarin will be essential for a career in agriculture?
I don't think so. I don't think it's going to happen like that. Hopefully it's not essential for a career in law these days, even though we do have a lot of lawyers in China. I think in the next 5 years, I agree with David, there's going to be a lot more corporatisation. I don't think it's going to be a massive tidal wave by any means, but I think that trend will continue. I think a lot of the capital will be from offshore, at least in the next 5 years, China in particular, and the US. Looking out to a 10-year horizon, I would hope that some of the impediments to investment by Australian superannuation funds have been overcome, or at least on the way to being overcome. I think currently the categorisation by Australian super funds of agriculture or agribusiness in the alternative asset class is obviously not helpful. We need to build greater price transparency, build new structures. So the idea that John mentioned of real estate investment trusts, I think that is an idea that's time is due. It is used throughout the world. I think the failure of some managed investment scheme investments for retail investors has sort of tarnished the whole trust industry for agriculture. But when we're talking about real estate investment trusts, we're talking about something that's fundamentally different. They're wholesale-only products. They're a well-worn path, and it's a vehicle to get greater investment into agriculture. I hope to see that part of the industry developing. And with superannuation funds, it takes time. Infrastructure is something a lot of funds are very keen on at the moment. They've been through that before. Some of them got burnt pretty badly, and it took a while to come back. And I think it's important that when super funds do start making a move into agriculture, that they're successful investments, the investments are set up so that they will succeed. And we only need a very tiny part of Australia's superannuation funds to go into the sector for a huge difference. So I am very hopeful that over at least 10 years, we will see the changes in the sector that do make it an asset class in its own right, that it's not lumped in with hedge funds and private equity and other alternative investments, but it is an asset class in its own right that's predictable, and really there's no reason why it shouldn't be. Superannuation funds are looking for the longer term. Many of their members are not retiring for 30 plus years. Agriculture has a natural fit. If we can overcome some of the other issues in terms of transparency, pricing and liquidity to an extent, I think we can have real changes in terms of Australian institutional investment into corporate agriculture.
Yep.
I think one of our real challenges, which we've alluded to, is match as this outside capital comes in, is matching it to the needs of farmers. So effectively, that outside capital comes in big chunks, $100 million chunks, $300 million chunks, maybe $50 million chunks. What we've got over here is a whole heap of family businesses that want capital, but by God, they can't deal with $50 million chunks of capital. So what we've really got to think about is how we match that incoming capital, because the funds want to invest in large dollops. They don't want bits like a Vegemite scattered thinly all over the place. They want a couple of big bits here and a couple of big bits here, because for their point of view, that's much easier to manage. So what we're lacking across a lot of industry is the structure for a good farmer to get access to. You might only need $1 million of that, or 5 million, or 10 million. But we've got this disconnect in terms of the requirements of capital and in terms of funds wanting to place it versus farmers wanting to use it. And structures will change and to deal with that. But that's a key issue I think we need to think about.
I think Ben reckons we're going to be taken over by Kiwis.
No, I don't. But I think, David, to that point, maybe the investors also need to recognise that the pathway to high returns is that skillful farmer has some upside or some equity or some skin in the game. And they can't all run 100,000 acre farms. So to me, and I've heard a couple of examples of professional investors here who are structuring things around finding good farmers and enabling them to buy or acquire or earn equity in a good scale farming business that they can run and keep a pretty good handle on. And by perhaps trading off, giving away, or maybe not giving away, but enabling someone else to take some equity, the reward is that that's the best way into that top 25%, as against the model where you've got big, huge enterprises owned by professional investors, but the management is very problematic. And so I think there's real money to be earned in finding a way to give those good quality farmers some equity in that larger scale business, not owning it all themselves and not having the professional investor owning everything themselves, but having a bit of a share, and the payoff will be higher returns. Right? So, Mick, to answer the question, I think the future, firstly, is really bright. We're very fortunate to be in an industry at exactly the right time. We know demand for food is high. We know it's going to stay high, and it's going to be growing. We've got limited resource. What a brilliant industry to be in for the next. Agriculture's been a pretty damn hard place to be for a fair bit of the last 100 years. The next 50 years, I think, is going to be lots of great opportunities because we know demand is strong. We shouldn't write off our competitors on the supply side. Every other agricultural nation in the world is sitting here looking at exactly the same opportunity. The South Americans, Africa. We've been talking a lot about off to the side about Africa. Everyone else is trying to capitalise on this, but Australia has got a lot of great advantages in terms of really being able to capitalise on it. But we've got to do more than just turn up to really, because it will continue to be a very competitive marketplace globally. And I think in 10 years, the consolidation trend is irreversible. I think that's clear. Farms will be bigger. There'll be a range of different investors who own those farms, not just farming families. That evolution will continue. But I really hope that the role of a farmer who has equity in a good scale, large scale enterprise will still be the sort of foundation stone of farming in Australia.
Okay. We've had some good discussion amongst the panel, but I know there's some pretty good brains out in the audience as well, if it's not all frazzled at this hour of the day. So does anyone have any questions or comments they are interested in making or even asking of our panellists before we finish up? Yes, we've got one right in the middle. Kylie?
Yeah, thanks, Mick. This is really Malcolm Letch from Department of Ag in Queensland. This is really a question for the banks, I guess. Given that I'm not an economist, I'll make that up front, but I'm going to give you a few assumptions. That assuming government gets out of the way and allows the adjustment to happen, so the bottom 25% to exit where they need to, assuming that a lot of the top 25% are already at optimal scale, assuming that we are saying that middle 50% is where a lot of what Ben was just talking about, that growth is going to happen and what have you, and assuming that a lot of the capital that they're going to need is going to come in the form of debt from the Big Four, are the Big Four well equipped in relation to being able to advise those people in relation to the sorts of risks that they're taking on? Because we've all heard the horror stories of those sorts of very good farmers trying to get big and failing when they take that next step.
Big Four plus Rabo.
Big Five.
Careful.
Look, I'll put my take on it. And I think we've heard this a couple of times, certainly from Karen's introduction yesterday and some in Graham's session yesterday. There's actually top 25% at various sizes of farm operations. So it's not just about the big. It's actually about who's doing it really, really well, and it's what levers, what sorts of things are they doing that's really, really well. The stuff that I've seen in the dairy industry and in Victoria, and I have been to New Zealand a few times, Ben's lived it, I see them really digging into that stuff intensely, continually, and really driving at it. So you could argue that with the debt that's been put out there, we've actually made some incredible capital investments, both in property and equipment, and we actually haven't realised on that fully yet. So you could argue when you look at those debt growth numbers and the investment that's been made, that we actually haven't had a period, whether it be weather or whatever, that actually hasn't realised. And even in Western Australia, with their record production last year, and they've had some pretty hefty debt levels, that they finally had a year where they realised on their investment. So that argument, you know, who knows? The question is the investment that is out there being fully leveraged, and how do we get optimal performance? And that's about getting those other producers, you know, really aspiring to get up to that higher level. So I'd come at it from that point of view. I don't think it's an issue of people need to go and buy massive amounts of land, and in fact I think quite a few people have gone and done that, have absolutely underestimated the time frame, absolutely underestimated the operating risks, and you know, banks could be blamed as being part of that learning experience that we went through pre-GFC in particular.
It's interesting, isn't it, because you're seeing that gross debt number in agriculture taper, but production growth still occurring. So perhaps that thesis is right, that the capital is starting to be better utilised because the growth in debt slowed down a bit, and they're actually having to have a look at it and work out how to make it better.
The weather's been pretty nasty, and the risk we've taken is, you know, the risk.
I just want to make a comment on scale. I think the real opportunity for a lot of successful family businesses is actually to go the next step in scale, because they've got the management expertise. What they don't have is the capital to make it happen. And so my comments yesterday about scale were at the individual farm business level. So, you know, if your farm business level is getting too large, you get diseconomies of scale. You can still then set up multiple units and spread your management expertise across those units, rather than just having a bigger and bigger farm per se. That's where I see the risk. So I think the scale issue is we need more and more scale, because we need to spread those smart people over more hectares and afford to pay them competitive salaries and all those sorts of things. So scale like that is good, but scale at management unit level, we've also got to get right.
I think the quick comment on the question about have the banks got the necessary skill set to assess the risk. If they don't, they sure as well need to. And I think by and large the banks do. Question is how focused do they get on agriculture, because the risks are, you know, very different to a normal commercial business. So, but it's in the bank's financial interest to do that, because you've only got to have 1 in 50 or 1 in 75 loans go wrong, and they'll pay for it, right? So banks need to be, pre-GFC, banks around the world were highly irresponsible with the way they handed debt out. I mean, that's a generalisation. I know in New Zealand, I can't speak for Australia, but lending was too indiscriminate. And having too much leverage or too much debt in a business where the farmer cannot manage it leads to tragedy, right? Leads to not only people losing money, losing livelihoods, you know, losing their whole identity. So debt badly handled leads to problems, deep problems. And in an environment like Australia, where you have got more than your fair share of black swan events that come in the shape of drought, flood, just the whole climatic scene, banks need, and I think the banks do by and large, but they need to understand that, and the farmers also need to understand it and build it into their planning, that sort of stuff is going to happen. And if you gear a business up to the point where it needs everything to go right for the next 2 or 3 years, almost always you're going to be disappointed. Something always goes wrong in a farming business. And That's why a bank, I think there's a maximum level of debt which should be applied against farming businesses, and to go beyond that is really just wishful thinking.
Frank. Oh, hang on. Someone else? You're right. No, you've got the microphone.
Sorry, Eric Hall from Plant Farm. Just a point on the banks, that's the big 4 plus 1, with relation to who are the top 25%. It's interesting that the top 25% of the numbers put up by Graham and others is actually based on a return on capital basis, whereas the top 25% that was put up with the ABARES certificates had a heavy weight of equity within that number. I'm a bit concerned that potentially the top 25% are considered the highest equity holders and not the best farmers. We speak about management all the time. We've spoken about returns, we've spoken about profit, but in our experience, when it comes down to who the bank is actually supporting, they seem to be supporting those who have the equity in the land of which to recover their security at the end of the day, rather than necessarily the intellectual equity, the management ability, and the backup to actually get through those black swan, as you call them, timeframes. And that was particularly obvious in the last sort of 2 years. A lot of good managers, good farmers who did still retain equity were basically restricted from developing, and interestingly several of those were within that top 25% on those numbers. So the other comment was also the banks talk about what products can be used later. It'd be interesting to see whether those policies are actually being worked upon, particularly by the credit policy people, about being able to support that ownership separation from the operation, how you fund the operation, given that main lenders in Australia are not that interested about funding against crop and livestock, as opposed to the dairy farm in New Zealand. Thank you.
Well, there's a challenge for our bankers. Do you only lend on equity?
Well, just to be a little defensive of the banking sector, there's a very strong relationship between equity and probability of default. So businesses that have strong equity have a much lower likelihood that they're going to default on their loans. So, and there's a lot of analysis around that. I've also seen lots of very innovative, very good business plans with lots of great ideas. But I'm not going to lend against that unless somebody has a good track record, and it's one thing to see it on paper, but you actually need to back the track record. And I think where we're most likely to step outside of our normal policy areas on lending, which is generally over the loan to security ratio policies that we have, is where there's a proven track record that people can generate cash surpluses. You want to do that on track record rather than promises, because often the promises are not met. So.
Yeah, I mean, it's a complex issue in terms of how banks keep fine-tuning their underwriting standards, if you like, to experience, and there's always leads and lags in that. Post the GFC, you'd have to say that one of the big lessons was that people taking on large debt for big land purchases, there was an underestimation of how the events would sort of come together, and probably the one saving grace we've had has been lower interest rates. So it could be worse. It could be a lot worse. But the consequence of having making a large capital purchase and borrowing a truckload of money to do that is the interest that just accumulates that, and if you can't service that interest, it keeps accumulating. So it catches up, it snowballs very, very quickly. So this, I guess, almost corruption of working capital and long-term capital and rolling all the finance in together, I don't think has been particularly well managed, unfortunately. I think there's been a lot learned from that. The people with high levels of equity hasn't been such an issue. But those that start to get up against the wire, and then you overlay on that tighter bank regulation, which is essentially what has taken place post GFC, the banks don't have the latitude to start doing things outside of the system, if you like. So you've got to start providing more capital against that farmer's loan. And I think I was telling Mick, I've spoken to producers where we've got them through. I've got them through over a number of years, and they're still operating today. but I know it's cost my bank shareholders $6 million. The producer hasn't seen that bill, but I've carried them through. My business is, you know, we've in terms of the bank's profits, it's paid that $6 million out. That's business. Yeah, I don't have to pay it. But I
Frank,
do.
we'll
Yeah.
give you the final say.
I just think that's business. You've got to share some pain to gain. You've made some decisions that you regret, so does farmers.
Yeah, yeah.
Tell us the sad stories because you've got to see some of them.
Yeah, no, it's a good. I'm quite proud about the story. And yeah,
I think he's
yeah, but you know, when you're running a big portfolio in an organisation, a big bank organisation, how long are they going to prepared to pay that? You know, they're a big corporation that needs to make returns for shareholders. So we need to keep reviewing, recalibrating. What are we learning? How do you change it? My point is that this going out and buying big chunks of land and having your back against the wall in terms of that's the maximum of what I can do and I've got no room to move has proved to be quite a risky path to go down. And so some of the things we're talking about here about separating capital and working capital and so on, I think are, you know, really worth exploring going forward.
We're right up against our promised time, so I will grant one final question over
Yeah,
here.
thanks, Mick. Gary Hanson. I'm actually a practising farmer from South Australia.
Still practising.
Still practising. And given that South Australia, the farm sizes tend to be, this is broad acre cropping sheep, cattle, tend to be a little bit smaller anyway, but a little bit of anecdotal evidence that I'm seeing in South Australia is that there's been more and more properties leased to enable farmers to retire than ever before, right across South Australia. So I think that's going to be the source of capital. Now, why is that happening? I think because interest rates are low and also they don't want to invest in the share market because of volatility. Most farmers that I see that are retiring in South Australia have actually been able to organise a retirement home somewhere. They just need living funds and they can get that from there. So, and we've been participating in that on the lease side. So short term, I don't know how long that's going to last for, but certainly I think for the next 10 years that's going to be a major source of capital in some areas.
Okay. All right. Look, thank you all very much on the panel. I know you didn't necessarily volunteer, but that's life. We have to get our volunteers from somewhere. So Stephen, Graham, David and Ben, thank you all very much. I think there's been a very interesting discussion and it's brought together a lot of the threads of the conversations over the last 2 days quite well. So hopefully we've all got some benefit out of that. To all of you who participated, thank you very much. Particularly to Kylie and Sally who kept us all organised. Thank you very much for that. The final thing I should do is thank the sponsors of the Farm Institute. We are a not-for-profit. We get involved in policy issues only through the very good graces of our corporate supporters and our individual members who help us to do that with their hard-earned readies. So we're always extremely grateful for that. We hope that we bring some value as a consequence of that. And if there are those in the room who see fit to add to that resource that is absolutely essential for our operation, we have ways of taking your money. So with that, I'll thank you all very much for your attendance. I hope you have safe travels and no doubt we'll see you around an agricultural forum in the not too distant future. So thank you very much.